Hi, I'm Jimmy. In this video, we're looking at Exxon Mobil, ticker symbol XOM. We're going to look quickly at Exxon Mobil's business, and then we're going to see if we can come up with a fair value for Exxon Mobil's stock using a discounted free cash flow valuation. Okay, so before we jump in, just recently I actually did a video where I went through how overvalued the stock market is right now. We use different methods like the PE ratio, the Shiller PE ratio, the Buffett indicator, things along those lines. Within that video, we broke down each of the 11 sectors by their PE ratio, and energy turned out to be one of the ones that could be undervalued. That was the reason I actually chose this stock, because I figured this one, Exxon Mobil and Chevron, were the two most logical places to start, because I'm really looking for another addition to my personal portfolio. So, if you're curious, I'll leave a link to that video in the description below. But basically, that's how we got to this video. Okay, so let's jump right in. So Exxon breaks their business into three primary segments. They have downstream, chemicals, and then upstream. The upstream part of their business is where they drill for things like oil and gas. Downstream is where they sell it in either gas stations or they produce it in refineries. They refine it in refineries. And then the chemicals part of their business is where they produce things like polypropylene, polyethylene. Those are things around plastics. So, as we could see, the downstream part of their business dominates their revenue, at least it did in 2019. And in their 2019 annual report, they also publish where in the world they produce this revenue. So we can break these down one more time. And in that, now we can see that each segment is actually dominated by non-US revenue. So once again, this is a very global company. So focusing on the downstream part of their business for a moment, well, downstream is generally broken into two categories: refining and marketing. Refining is where they take crude oil, convert it over to gasoline, things along those lines. And then the marketing is places like gas stations. That's where they actually sell the final product. And one obvious question might be, with the rise of electric vehicles, well, isn't Exxon likely to see a huge decline in the consumption of their gasoline? And personally, I think that yes, in the long run, that's going to happen. But I think that's going to take a very long time for us to get there. In fact, this is a chart of the consumption of crude oil and liquid fuels. And this was leading up to 2020. So pre-COVID, this is how consumption was going. And as we could see, well, this trend was trending higher despite the bigger and bigger impact of electric vehicles, companies like Tesla. Then when COVID hit, well, we can see that consumption tanked. People stopped driving, businesses began to shut down, manufacturing slowed. So there was a global shutdown of consumption, or a global decrease of consumption. As we can see, the number is still quite large. So there was a global decrease in consumption. But then, since the bottom, well, as different economies have come back online, consumption has gradually begun to increase again. So I'm expecting, as the economies begin to ramp up further throughout the world, as more economies come more fully online, I would expect for consumption to continue to ramp up. So that's a good thing. Now, another product that many energy companies focus on, Exxon Mobil included, is natural gas. And as we can see, well, this is put out by the Department of Energy, and this is the natural gas consumption. As we can see, the overall trend is in fact higher, and it's likely to continue to climb. Now, natural gas is often used for the heating of homes. It's used to generate electricity. There's many industrial uses. They have some commercial uses. There's even some use in transportation. And as we may imagine, these spikes that we see here, well, those spikes are weather related. Of course, the need to heat homes with natural gas, or even heat businesses with natural gas, are going to be much higher in the winter. Hence, you see overall consumption in winter being much higher. But again, the overall trend is moving up. Now, the reason that I bring this up is that every now and again, I'll see different comments on different videos, and they talk about energy companies being dead. Any companies that are tied to oil or natural gas are dead. And usually it's presented in the context of a company like Tesla. And while I agree that, yes, the future of vehicles is going to be a company like Tesla, or a group of companies like Tesla, electric vehicles is where the world is going. Right now, there's over 1.2 billion gasoline vehicles on the planet, and there's only a handful of millions of electric vehicles in use right now. So compared to 1.2 billion, they got a long way to go. Now, I'm not saying that things are all good for a company like Exxon. In fact, this is their revenue chart going back the past few years. And as we can see, revenue has been gradually falling. Now, obviously, consumption is not the only factor to consider here. Otherwise, these numbers would be moving higher. Here's the price of crude oil as an example. Obviously, the price of crude oil, if Exxon could sell oil at $100 a barrel when it was back up here, and then a year later, they're only able to sell that same barrel of oil for $50 or $60 or $70 a barrel, obviously revenue is going to decline, assuming they even kept the same amount of production going. So clearly, crude oil prices are going to have an impact on overall revenue. In fact, if we were to overlay crude oil on top of the revenue chart, well, we can see that when crude oil began to decline, well, that was about the same time that the revenue significantly began to decline. Now, if we were to switch out crude oil and replace that with natural gas, well, we can see that once again, especially in the early years, as natural gas prices began to run up, well, revenue for Exxon Mobil also began to run up. And to consider another factor, well, on top of oil and gas, there's something known as the crack spread. This is a chart of the 3-2-1 crack spread. Now, this is just one example of a crack spread. There are many different types of examples, many different ways to use the crack spread, many different crack spreads out there, but this is one example of them. And basically what the crack spread does is it tries to estimate the profit per barrel of oil, and this is mostly focusing on the downstream business. So usually it's in refineries, it's important to refineries. So the downstream business, which is one of the main parts of their business. So this is very important to what Exxon does. Just to illustrate what the crack spread, how the crack spread is used. So in this example, you have 3 barrels of oil refined into 2 barrels of gasoline and 1 barrel of distillate fuel. So what would the profit margin be, assuming that was the ratio that came out? Now, every quarter, every year, every company is going to have slightly different ratios. That's why you would look at something like the crack spread, and it's not dollar for dollar exactly what they get. It will be some variation of that, but it is a good way to roughly estimate how the downstream business is doing from a profitability standpoint. Now, when we overlay the crack spread on top of revenue, well, we can see that broadly speaking, when the crack spread was at its highest, well, revenue was also at its highest. So we can see that there are many factors that contribute to revenue growth, profitability, and how far and how fast a company can ultimately grow. With the crack spread, if oil prices stayed the same and gasoline prices shot up, well, you would see an increase in the crack spread, and hence the company would become more profitable. That is why it's very important to understand each business, each line of business, and to be able to track what is the fundamental drivers behind that business. With all that being said, what do we think Exxon Mobil's stock is worth today? Well, to come up with that, I actually did a calculation of discounted free cash flow using analyst estimates for Exxon Mobil stock. And if you're curious how we did this whole calculation, well, I actually did a video where I walked through step by step how to do this type of calculation. I created an Excel template. You're welcome to have it. This is actually from the Excel template. So if you're curious, I'll leave a link to that video in the description below. But basically what we did is we took analyst estimates up here. And one interesting point that I think is important is, it may not be a surprise, but 2020 is expected to be a negative year for Exxon Mobil from a free cash flow perspective. And 2020 is almost over for Exxon. They actually completed 3 quarters already, so it's really just the final quarter that remains. So yes, it is an estimate because they're including that in there, but just so we're on the same page, they've only got the 4th quarter left to report. So basically what we do is we take our analyst estimates, we discount that by our required rate of return. For us, we're using 7.5%. We grow that out with a perpetual growth rate of 2.5%, and that gives us a fair value for Exxon Mobil stock of about $70 per share. But we're going to want to account for Exxon's debt in this whole thing because they get about $69 billion in debt. Well, when we add the impact of net debt is debt minus cash that they have on hand, well, that gives us a fair value. The new adjusted fair value for ExxonMobil stock is about $58 per share. Now, on a recent analyst call that I listened to, well, ExxonMobil came out, the management of ExxonMobil came out and said that they want to keep debt below $70 billion, which is good because they're mighty close to that right now. On that same call, they said that they also want to decrease their capital expenditures. And that's a good thing because if they decrease capital expenditures, that will increase their free cash flow. That's likely already accounted for in their free cash flow estimates, since these are updated numbers from analysts. So they would have accounted for that. But either way, another point that the management of ExxonMobil brought out on that call is that they believe that they will continue to be able to pay out their dividend. And that's a very good thing because their dividend has been consistently increased for many years. Exxon Mobil is one of those companies that many people rely on their dividends. So them maintaining their dividend is important to them, certainly from a perception perspective. Perception perspective, yeah. So hearing management say that it's important to them that they continue to pay out their dividend, we can only assume that their dividend is relatively safe, at least in the near future. Now, if we were to try to calculate what their dividend yield is, well, we take the past 12 months of dividends, we divide that by the current share of ExxonMobil stock, which is about $43 per share as of the shooting of this video. We divide that, we get a dividend yield of about 8%. Now, this is very important if we want to invest in their stock today, because right now, that dividend, we lock that in if we were to buy it today. This is known as yield on cost. So that's key for us to keep in mind. Now, our question is, should we buy it today? And for me, this is actually a very tempting stock. My only hesitation right now is I actually like the price. I like the margin of safety, but I'm a bit hesitant because what's better, Exxon Mobil or Chevron, just as an example? If you guys have done any research on any of the other companies in the business, please let me know in the comments below. But that's my only hesitation. We're jumping in and putting my own personal money in this right now, is that I want to hurry up and analyze some of the other stocks in the industry. That way I can get a better understanding of which company is the best. Because if I have a choice between two companies, ideally I want to research both. I don't want to just blindly go into one and not look at the other. And for dividend investors out there, well, right now, like I said, Exxon has a dividend yield of about 8%. The next logical company to analyze, in my mind, is Chevron. They have a dividend yield of about 6%. So if dividend yield is very important, perhaps that's enough of a differentiator for us to consider going with Exxon. But for me, I would love to be able to lock in the 8% dividend yield, but have a reasonable amount of confidence that the stock will also move higher. To me, that's sort of a double win. Now, I know I mentioned dividend yield on cost before, and if you're not too familiar with what that is, dividend yield on cost is a very important consideration for dividend investors to watch. It's something that it's key for us to understand. So if you'd like to learn more, I actually did a video on that topic where I go through what it is and how dividend investors can use it. If you're curious, I got a link right here to that video. I got a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really appreciate it. Thank you, and I'll see you in the next video.